Hi, Steve Sosnick here with today's Interactive Brokers Midday Market Update for Tuesday, April 28th, 2020. This was kind of an interesting one so far this morning. It's only about noon now as I'm making the video. We've already had a huge range on the broader indices. The S&Ps were up about 40 or so, at least the futures were when we opened this morning. And now when I look at them, I'm just looking at my screen here, they are actually down about 5 points, and they have been a little bit lower. They're still up substantially over the past few sessions. It will be interesting to see if there's an attempt to sort of close the gap there's a very slight gap, between yesterday's open and the prior day. So we would still have to fall. We would have to fall about 25 points for that. So it's not clear to me that we're going to try that. But stranger things have happened right now. So what gives? Well, first of all, I think it's pretty clear that the market rally has been predicated on a very accommodative Fed. Markets love accommodation from the Fed. I've wrote about it before. I've talked about it before. In some ways, maybe the markets are thinking, okay, well, we've privatized gains and socialized losses, because if the Fed is providing this backdrop, then we're pretty much free to invest. There's always the talk of what they call the Fed put, which isn't an actual put option. It's basically the fact that the Fed will do what they've done and come riding to the rescue to avoid defaults in the economy and to keep the financial system afloat. This is all what they should be doing. I do tend to worry that I think what they're doing is they're not doing this because they want to be. They're doing this because they have to be. And over the past few years, what we've seen is when the Fed's been accommodative or responding to some sort of crisis, equity markets love it. There might be deflation elsewhere, but we can always inflate asset prices is sort of the rationale. But I do think that that's, as I've written before, that's a necessary but not a sufficient condition. What we're starting to see now is companies eliminating their dividends. One of the rationales for equity investing in this environment is with interest rates essentially at zero, you might as well invest in equities because you can get yield and capital appreciation. And so that is a good rationale. But if the yields keep decreasing overall because dividends are getting cut, well, that takes out a big piece of it. One of the marginal buyers over the past years, pretty much since the 2017 tax legislation went into effect, 2017-2018 tax legislation went into effect, which gave incentives for companies to do buybacks. I think buybacks are going to be very much out of favor. I don't see boards racing to do this because many companies that had been aggressive about buying back their shares wish they had the money now. And I'm going to pick on the airlines to a certain extent, but it's not only them. So without buybacks, without dividends, that does take away some of the investment thesis. Yet we find ourselves on the S&P back at levels of where we were in the fall. Markets tend to look 6 months ahead. In the fall, things look pretty rosy. As of now, I defy people to say how good it's going to be in 6 months. Companies certainly aren't saying it. Almost every company is withdrawing their guidance. And I find it hard to believe that we would be back to where we were prior to this crisis within the next 6 to 12 months. Some of the stuff I'm hearing, various economists saying it could take as long as 2 to 3 years or more to get back to where we were. So what is the only other thing that could justify pricing the market more or less where it was 6 months ago? It's the monetary accommodation. It's the lack of risk that investors perceive because you think the Fed has your back. It's oversimplistic to say, but why hedge if the Fed's going to do it for you? That's not a very healthy attitude, but that I think is going through a lot of investors' minds. But today, I think you just sort of had enough. I think the market just sort of outkicked the coverage, so to speak. And it's interesting where the lack of leadership comes from. And we started to see it yesterday, where it was a broader tape, and with some of the former market leaders acting the worst. And today we're seeing growth certainly outperform value. If you want to look at a little tell on that one, There's two Vanguard indices that are a very good tell for growth versus value, VONV and VONG, and I keep them on my market monitor to sort of as a quick way to see who's outperforming where. One of the reasons the growth stocks are underperforming is because so many of them have earnings this week, and I think people are getting a bit nervous ahead of earnings with the lack of clarity. Today, we're expecting Google and Starbucks after the close. My son was in shock the other day because I guess they went out to buy groceries and saw a line at Starbucks, at least through their drive-thru, right? And so people still view Starbucks as a necessity, which I guess is very good if you're a Starbucks investor, but we'll see what they have to say. We'll see what Google has to say. And as we go through the week, I'll refer you to a chart that I put up yesterday on Traders Insight about the header was basically, do earnings matter? We'll find out this week with where we're going to see the roughly 50% or more of NDX reporting and about 25% or more of SPX. And that was only selecting certain the most important companies. So this is a big tell all week, and I think prices are starting to reflect that today. We'll see where we close. We'll see where the market ends. But there's a lot to look for in what promises to be a fairly exciting week. Take care. Bye-bye.